I always tell people that the next hotspot of latency is where you least expect. So in our experience, again, that each organization, each market has a definitive hotspot. By definition, there's always a weak point, there's always a weakest link. But we very rarely find it consistently to be the same place at the same time for any given organization. And this is where kind of the search begins, is that what people are trying to figure out is that within their current setup, where is the weakest link? Is it, the first question is it within my infrastructure or is it outside my infrastructure? Am I to blame or is someone else to blame? Now, we can take trends. What we find is that the hotspot does move from a technology perspective, because what we've seen is that typically the way it goes is that either the exchange is the bottleneck or the participant is the bottleneck. We've gone through 2 cycles of this now already, where previously it was very much the exchange is the bottleneck. Their matching engines are not up to speed, their gateway's not up to speed, where the high frequency guys, like when it started up with the prop traders and whatnot, they were always much, much faster. We've seen a whole new wave of technology investment in the exchanges where we've gone from tens to hundreds of milliseconds in terms of exchange response times and speeds, now down to sub 100 microsecond is really the new benchmark. And even the next generation systems we see now sub 20, sub 10 microseconds in terms of matching engine response time. So we're seeing 2 cycles of technology improvement. What happens is once the exchanges get faster, then a whole new wave of opportunity happens on the participant side to say, if I can get faster again, I'll retake my competitive advantage. So what we're seeing is algo response times went from of order of hundreds of microseconds to move into FPGA style devices, where now we did a release a couple of months back with Nomura where they recorded their pre-trade risk engine to be 2.7 microseconds. And so we're now into the sub 10 microseconds on the participant side. So you can see that that's what's driving the next generation matching engine to be sub 10 microseconds. And then in between, you have connectivity that has to subsequently decrease, because otherwise that gets out of kilter. Once something becomes a high percentage of the overall trading loop, then that's the next obvious thing that's going to change. And that's what we saw the drive to colo, because if you weren't within colo, then it didn't matter the fact that you were at 10 microseconds on either end, because you weren't getting the advantage. So if you were using those technologies and you weren't in colo, you weren't going to get the return on investment. Now, this is what's starting to happen within the Asian markets, is that those technology advances are starting to come into play. Within Asian markets, there's a much greater diversity on the latency landscape, because people are implementing multi-venue trading strategies where they may be trading to one exchange that's actually super fast and another exchange that's actually, relatively speaking today, super slow. Interestingly enough, that type of environment most likely creates greater arbitrage opportunities for the modern day trader, because it works on the principle of relative latency. So if you know that you can get a fast price versus a slow price, you can work that into your strategy. And the great challenge within the Asian markets, of course, is having an accurate understanding of how fast or how slow a given venue is likely to react to your trade.